I believe in America. I believe in the American economy. I'm bullish long term on the American economy. We have a housing shortage. So, in my mind, long term buying housing is going to be a win. Um, Investors all over the world want to invest in America, right? One, because it's a good place to invest, but another reason is their capital is safe.
Hey, what's up, all of my real estate peeps? This is Brian Lucier with another episode of the Why Not Real Estate Podcast, where we interview successful real estate investors in the multifamily realm industry, which we believe multifamily to be one of the best asset classes in real estate. So let's get started. Today's guest is the founder of Spark Investment Group, is a real estate expert with more than 4 decades of real estate investing experience. I can hear him chuckling out there.
Yeah.
Including 35 years as a realtor, navigating the unique real estate landscape in Silicon Valley, California. Through his experiences, he developed a passion for helping others achieve their own financial freedom through investing in multifamily real estate syndications. He's currently managing and operating a multifamily portfolio as a general partner and sponsor of over 1,100 doors, 1,100 units, with a total value in excess of $138 million. In addition to his GP holdings, he is a limited partner in over 500 plus units located in the Southeast and Mountain West area. We'll find out more about that in just a little bit. Through his investment firm, Spark Investment Group, he also put his decades of real estate experience to work for his clients, helping them to reach their investment goals and attain the very lives they've always wanted to live. Ladies and gentlemen, all of my real estate peeps, it is my pleasure and honor to introduce onto the podcast today real estate entrepreneur and founder of Spark Investment Group, Mr. Arn Cenedella. Arn,
well, thanks, Brian. That's a great introduction. I'm flattered and look forward to chatting with you and your listeners, and hopefully we can help move them along on their real estate path and get into the game and start reaping the benefits of multifamily investing.
That sounds wonderful. And Arn, just so our viewers know, I've been kind of semi-stalking you on the web since we've introduced each other. We actually found you on Bigger Pockets. You were very helpful responding in some of the questions I had on the forum. So if any of my peeps out there are on Bigger Pockets, please look up Arn. Very, very knowledgeable wealth of information in the multifamily space. And you can, again, find him on Bigger Pockets. And of course, you could Google Spark Investment Group. He's got some wonderful publications he'll share with you out there and has been on scores of other podcasts. So if you like what you hear today, there's definitely more down the road that you can get from Arn. So Arn, if it's okay with you, we're going to roll right out.
Let's do it.
All right. So Arn, I've done a little bit of the research. I know a little bit about your story, but for our listeners out there, could you tell us what you used to do before becoming a real estate investor?
Well, I was just a kid before I became a real estate investor. So typical American middle-class kid, grew up in the San Francisco Bay Area. Parents said, do well at school. So I did well at college, grad school, got a master's degree in physical chemistry, and then wanted to return to the Bay Area. So my father was running a residential brokerage business in Menlo Park, California. So at the age of 24, I gave up academia, moved back to California, got my real estate license, and worked as a residential broker and investor for 35 years. So that's how I kind of got started. So my entire adult life has been in the real estate industry. 4 or 5 years ago, I transitioned kind of from single family to multifamily investing and love what that offers. So lifelong real estate guy. Real estate has been, as the expression would go, very, very good to me. So I'm happy to help other people kind of have success in their investing. And, coming from Silicon Valley, people make big salaries, but they work 60, 70, 80 hours a week. And so I think through real estate investing, some of these high income professionals, individuals can find maybe a little bit more life work balance through real estate investing, creating an additional stream of income, and then maybe at some point become work optional, and they work if they feel like it. If not, that's okay too. The real estate will take care of them.
So I take notes as we go here, and I heard you at the beginning there say that you were in college studying and all that, moved back to California, and it was family that first got you involved with real estate?
Yes, yes, my father, Attilio Harold Cenedella. So, born in Boston, his dad immigrated from Italy, and we had a little chat about our roots there. And he started a residential brokerage business, and fate would have it, I went to work for him. He was a great mentor, teaching me both the brokerage business, but even more importantly, the investing business. Surprisingly enough, a lot of realtors, a lot of agents, brokers aren't heavy real estate investors. And I kind of scratch my head about it. But my father really understood the brokerage creates the income, which creates the extra capital to real estate invest. And really, it's the investing that creates financial wealth, security, and freedom, where the brokerage provides the income to kind of get that going. So that's kind of how I did it. And it's worked, it's tried and true. And I was fortunate my father was a very shrewd investor.
I have to tip my hat to you. I learned a lot of this industry from my father, and for me, and I'm sure it was for you, it's a blessing to be able to work with your dad on something like this, because the dinner conversations we used to have about things in his later years, as I learned more and was able to expose him to new things, I could just see him light up, and just that life would come back to him. So blessed
Yes.
that you were able to do that with your dad.
And we also know dads can sometimes be critical, which is okay. When we need a kick in the butt, they're there to provide it. And certainly my dad was no exception. So fortunately, I've matured through the years and trying to become a better, human being and man as I go. So fathers are pretty good at pushing you along in the right direction.
I would always give my dad the credit when he'd call me a pain in the butt. I said, well, I had a good teacher.
Yeah.
Yeah, something else my dad used to say as I was becoming more successful. He says, Bry, you always seem to dive head first into a pile of horse crap. And I said, Dad, there's got to be a pony in there somewhere.
Yeah. And you really bring up an interesting point. And sometimes I say, in my life, I've leaped before I looked. Uh, so it sounds like we're similar in that we have forward motion, we're willing to try new things, we have beliefs in ourselves that whatever the world's going to throw our way, uh, somehow we're going to figure the way to make it through, right? And so I've never been afraid to try new things. Certainly, you want to educate yourself and you want to try to be prudent about what you do, which is maybe one advice I'd give is start small, gain some experience, and kind of ramp up. But understand it doesn't have to be perfect. I think some people sometimes get hung up on waiting for the perfect moment or the perfect plan. And in my experience, life doesn't work that way. You educate, you try something, you move in a certain direction, you learn as you go, you improve your game as you go, and you get better and better by kind of being in the arena, taking a few lumps. We've all made mistakes, but the key is to live to fight another day, right? As long as the wounds aren't mortal, you learn, you benefit from that experience, and you become a better investor. So I'd encourage your audience to get in the game. Even if it's not perfect, you're going to learn a lot more being in the game than constantly kind of studying the game, right? And so education, podcasts, get a wealth of knowledge, but then get in the arena in the real world and kind of cut your teeth and get started.
So you've just done a perfect segue into our next series of questions here. So the next series of questions, I actually split it up two part, and it looks like you have some great advice. So pardon me for repeating if you end up repeating some of what you just said there. But now I'm going to kind of turn on the time machine. In your 40-ish years, you must have started when you were 7. In your 40 years
No,
of
24, but anyway, go ahead. Yeah.
14, we'll go with 14. Yeah.
Okay. All right.
So in your experience, if you could go back in time, and you probably just answered the question, 2 prongs here. What advice would you give yourself as a real estate investor starting out? And you just explained very clearly what advice you'd probably give to someone starting out today. So you've already answered the second part of that. What would a newbie need to do? And I may drill down on that. I have some notes. But what advice would you have given yourself going back if you could?
Yeah, so great question. And while I do believe in a kind of systematic, step by step path to growth, right? Uh, if you're a beginner skier, your first time up the mountain, you don't jump off a black double diamond, right? That's not going to work. You start on the bunny slopes, you gain skill, and you move from blue to black, and away you go. So I think for real estate, that's a good way to start. And a lot of people start with single family homes. I guess if I knew then what I knew now, I probably would have transitioned from single family to multifamily sooner, where basically I kind of stuck with the single family rental. I was fortunate to start in the San Francisco Bay Area in 1978, where you could actually buy houses for rent. In my career, the prices went up 10x, 20x in the San Francisco Bay Area. So it wasn't a great rental market, but I moved to Austin, Texas in about 2000 and did fairly well there. So I think my advice would have been I could have scaled, transitioned to multifamily a little bit sooner than I did. I'm not one to have a lot of regrets, but that might be the one shift I would make is maybe after 5 to 10 years of single family rental experience, then moved into multifamily, where in fact it took me 35, 40 years to make that transition.
Wow. Wow. That is, well, I want to pick out a few points there. So yeah, you went through the step-by-step, that pattern, you built your systems, you built your operations, you tracked your market, you knew what you were doing, you built your base, starting in the single family homes, and then 30-ish years, 3/4 of the way into your career, you flipped the light switch onto multifamily. Very, very important there. Also, I've asked a lot of investors this same question, and then I always, what would you have done different? They always say they would have started sooner. And then the second answer I usually get when I dig a little deeper is they would have gone bigger faster. And I hear you saying that same thing. I want to go back to the newbie investor, just to
Mhm.
hit your bullet points again, to ramp up, start small, ramp up, learn what you're doing, educate yourself, learn as you go, get knowledge, build your systems. For today's market, today's climate, I mean, it's not the same as it was 10, 20, 30, 40 years ago. Things are different from when you and I both started. I'm halfway down that road for you. What other advice for someone starting out today? We've got new tools, new websites, all kinds of stuff. What other advice would you give to newbies today who might be on the fence wondering why not get started?
Yeah, so I think first of all, I think to be a good real estate investor, you kind of need to have a long-term perspective. Um, Real estate is a long-term game. Now, certainly in the multifamily space, 2018, 19, 20, 21, it didn't have to be a long-term game. People were flipping apartments left and right. And that was just because interest rates dropped, cap rates dropped, and it was able to kind of turn these properties over sooner. But in general, that's not how the real estate market really works. So in my mind, take a long-term perspective, and buy these properties right. And what I mean by that is, one, don't over leverage the property. Two, get long-term fixed rate debt, because I think that's really one of the major advantages to real estate as opposed to other asset classes. You can get long-term fixed rate debt. And then the other thing is, have ample cash reserves for when Murphy's Law strikes, when your roof leaks or there's a fire. Stuff is going to happen. And so if you go into it, lower leverage, ample cash reserves, long-term fixed rate debt, you can ride out the inevitable downturns. And so right now, maybe the real estate market's having a little bit of a downturn, but I would ask, people may be afraid, is this a good time to invest? And I hear the market may crash or it may go down a little bit more. I would simply ask people in your community, do you believe the price of housing, either rent or sale, is going to be lower 5 years from now, lower 10 years from now than it is today?
Hmm.
And I think most people could legitimately say, no, long term, the price of housing is not going to go down. That's not our life experience. If we were to go back over the last 30, 40 years, the value of real estate has gone up. And yes, you might have 4 or 5 years up, a year or two down, a year or two flat, and then you got another 4 or 5 years up. So if you have a long term perspective, you buy these properties in a secure way, operate them professionally, you can ride out a little bit of turbulence. And the only people who ever really get hurt in real estate are folks who are forced to sell in a down market. And as long as you set it up properly, low leverage reserves, fixed rate debt, you're never going to have to sell. You just keep operating the property. And like I can tell you, in 08, 09, the Great Recession, the subprime crisis, I had a bunch of rentals. And yes, the value of those properties went down, but I didn't really care because they were supporting themselves. And what I mean by that is the rent is enough to pay the operational expenses and your debt. So they're self supporting. So I just kept running them as rentals. And today they're worth way more than they were back in 08 and 09, right? And it was just a matter, I just had to get through that turbulent period. So if you do it right, it's fairly secure. And then just take a long term perspective. People talk about timing the market. Uh, I'm not one that actually believes you can always time the market. For me, it's put your capital work, keep it in the market as long as you can. The longer your capital's in the market, the higher probability of success you're going to have.
Golden stuff there. Just to reiterate, don't over leverage, long-term fixed debt, cash reserves, and that'll ride you through any market. I want to add to that. You know, I talk to a lot of people and they get afraid. It's like, well, I'm going to buy this apartment building. How am I going to pay the rent? And I just have to keep explaining to people, look, if your numbers work, you're going to collect rent. So just look at your model, even if you have to do it on 80% occupancy or 70% occupancy, as long as you're at a number that you think is realistic, that you'll be able to collect rents. And like you said, the income covers the debt, you're okay. It's not your pocket, your checkbook. You are providing a home for a family that needs a great, decent place to live. Hopefully that's what you're providing them. And in turn, they're going to pay down your debt. So from the 08-09 recession, where, like you said, if the only way you would have been in trouble is if you tried to sell during that time and you didn't have to. So now you rode that out. I'm guessing your rents have gone up a little bit since
A
2000.
little. Just a little. Yeah, pretty much. Yeah, they're
Or
doing okay.
500%, you know, just
Well, I don't know about 500%, but yes, they're certainly up from 15 years ago.
yeah, we'll conservatively say 300 and be well within that. But again, your
Yes.
debt probably didn't change, but your margins just spread of what you have to pay every month and what your income was. Sure, your municipalities and other stuff goes up, but all ships rise on the tide. If those expenses are going up, so are the rents going up, but your debt is solid. So
Right.
between that point and your debt, you're okay. And like you
Yes.
said, the only way you're going to get in trouble is if you have to sell in a down market. I want to circle.
And your debt's your biggest expense. So if you can have that fixed, kind of, the rest can oscillate a little bit, as you say, but typically those are just shifting with the rate of inflation, which typically your rent should at least do that or more. So as you say, the margin should increase over time.
And it does. It does. And your equity increases over time. And then there's all kinds of product out there where you can refi out and do it again, rinse and repeat, just using that model. I'm going to circle back to the newbies one more time. You have some really great advice, and I'm going to ask you how to do it. Educate yourself, learn as you go, get knowledge. Obviously, there's bigger pockets. There's the podcasts. What other direction, what other resources would you point a newbie in today? I mean, it's overwhelming with the amount of information that we have out there. So if there was a spot, and even if it is bigger pockets, what would you recommend for a newbie where they could get started, get their feet wet, and jump right in?
Yes, so great question. So I would say, uh, as much as I love bigger pockets and I have a lot of good interactions there and I've met a lot of good people in the space, if you're focused on really multifamily and large scale multifamily, then I think uh, going to conferences. I'm going to the Best Ever conference put on by a guy named Joe Fairless, Ashcroft Capital. That's in April in Salt Lake City. Dan Hanford does one in Charlotte in June. There's a variety of conferences. And so I would encourage um, new investors to go to these conferences. Brad Sumrock has one, Mike LeBlanc has one, Dealmaker Live. You can certainly find conferences, and I would go. And there's two reasons for going. One would be the content that's provided by the speakers, and the other one would be to network with people that can help you on your journey. So doing conferences, as you note, there is tons of information on the World Wide Web. And so new multifamily investors can find that information. I'd also suggest that maybe they consider join a coaching or mentoring program. And what that provides is additional networking opportunities within your team. And what you want to do, you want to associate with people who are maybe a step or two ahead of you.
Yeah.
So they can kind of show you those next steps. So if you're truly committed to kind of um, moving into multifamily actively as an operator, as a lead sponsor, then definitely these conferences and networking and mentoring programs would be good. I'd encourage the listeners, each of these groups has a slightly different flavor. They have a slightly different focus. Some are maybe very geographically focused. So I think as you're evaluating them, what fits your personality and your kind of style in investing and what you want to do. So for example, if somebody's ideal is, I want to start going after 30, 40 unit mom and pop apartment owners, that's going to be a little bit different program than I want to take down 250 unit syndication deals. And so look for a mentoring program that is fits with what you kind of want to do and what your skill set may provide. The other thing I would say is people want to know what's the best market to invest in. And I would say the best market to invest in is the market you know best, because any market you can make good deals. So I live in Greenville, South Carolina. That's the Liberty Bridge behind me. All of my syndication work is in Greenville County or the upstate. It's a market I know well. I'm here every day. And so don't spread yourself out over 5 or 6 markets. Because what also happens is you have to kind of hit a critical mass in a certain market before people start to take you seriously. So I'm an ex-California guy, and everybody knows California investors have a lot of money. And we know also a lot of California investors want to get their equity out of California, perhaps elsewhere. So these brokers all across the country in the Sun Belt, the Midwest, Arizona, they get calls from people in California all the day. But if you really want to start gaining traction with the brokers, get on a plane and go to that market and start meeting with those people face to face, because then they're going to go, hey, this guy or gal is serious about doing this. And so you got to kind of build that network. And then if you find your first deal in that market, leverage that to use to buy another deal in that market. Because if you go buy something in Winston-Salem, North Carolina, a market I like, it's about 3 hours from my home. If you go buy a building in Winston-Salem, North Carolina, when you call a broker in Winston-Salem and go, oh, I own the Elm Tree Apartments down on Main Street, that broker's going to know you're a real player and you're a real buyer because you actually own something. So I would say pick a market, really drill down deep into that market. And the other thing, just a real practical suggestion. If you pick a market that you got to get on 3 airplanes to get to, that's not going to work, right? Because you're going to want to spend time there. And so you need to be able to get back and forth relatively efficiently with relative ease to do it. So if it's like a 3-flight all-day journey to this market, my sense is you're just not going to be able to spend as much time in that market as you need, as opposed to you can hop on a plane, direct flight 2 hours to your market. That you can do on a 2-day trip. It's no big deal. So pick one market, make sure it's accessible to you, and then really drill down.
Some really golden nuggets here, Arn. Thank you. I want to circle back to the coaching and mentorship. One more benefit of joining a program like that is accountability, because they're going to have you put down in black and white what your goals are, and then they're going to hold you accountable. Did you make those calls? Did you jump on that plane? Did you talk to the brokers? Did you see the property? Did you do anything? And, knowing that coaching call's coming up next Tuesday, and if you haven't done your homework, there's a little bit of angst there.
100%. We all need some accountability. Sometimes we don't like it. But the other thing, the flip side of the accountability is you're also going to get the encouragement to keep trucking. And there's a saying, the law of the first deal. And what it means is your first deal is the hardest one. So you might own a few single family homes, but to make that jump and buy that 30-unit apartment, that's the most difficult leap. Once you buy that first 30-unit building, I guarantee you the second one will come more quickly and easier. So I can tell you on the first building I bought, 43 units, not a big deal, $2.8 million. I was in a mentoring program, and my mentor, even though I've been in real estate all my adult life, I was still kind of a newbie multifamily guy. So I was a little nervous. My mentor talked me off the fence, kept me on track. Bought the thing May 2021. It's killing it. It's doing great. And without that encouragement and kind of support, I may not have stayed the course. And we have now, my mentor and I have even partnered on bigger deals in Greenville. And that's the other interesting thing about multifamily. And one of the reasons I actually made the switch. As a single family investor, you generally do it all yourself. You find the property, you work with the property manager, you do the financing, you do the accounting, and it's kind of a one-person show, where multifamily most often is done in kind of a team aspect. And the great thing about the team is each person on the team has a particular skill set. And each person may have a particular weakness that maybe somebody else on the team fills. So the team aspect's really critical. So for me, I'm kind of a big picture guy. I love to hunt deals. I'm the hunter on our team. Love to hunt deals, love to network, love to talk to investors. I don't quite enjoy as much the day-to-day, and let me use the word drudgery, of dealing with tenants and property management and all that. Fortunately, I have a partner, Brian Walsh, who loves doing that stuff. So the multifamily is kind of a team sport. So I think as you go out there and you're trying to make a deal, look for people who have complementary skill sets to you, who bring unique perspective. The third member of my team is the brain. He's the spreadsheet guy. He's the analytical guy. He loves looking at numbers, crunching them. So we kind of have the hunter, We have the mind, we have the brain, and then we have the operator, which you might also call the hammer. He's the one who actually gets things done. So that's a great thing about multifamily, because I can play to my skill set, and all your audience can find their kind of, let's call it a superpower, play to that superpower, and then find partners that fill in the gaps. And then united as a team, it's what would you say? The sum is great. The whole is greater than the sum of its parts. So you get 3 or 4 people with complementary skills, and now you really have a formidable team. And that takes a little pressure off you, because you know you have teammates you can count on. So that's one of the things I really like about multifamily. Now, of course, you got to find the right partner, and you don't run out and get married after for one date. You know, you have to take some time to get to know these people and kind of make sure you're all on the same page about investing and how you conduct yourself in life.
So I have a question for you. Was
Okay.
the mentor that you were working with, your coach, was that Brian Walsh?
No, that was another person.
Okay. So you make a really good point there. Like, success attracts success, right? Success leaves footprints. So you have your superpowers, they have their superpowers, and they'll see your superpowers. They'll recognize in you what your skill sets are, and vice versa. And eventually, because success attracts success, you know, you were working with your mentor, he saw skills in you, you saw skills in him, and now you're working together. So you become
Yes.
your own Justice League, or Avengers, or whichever Comic-Con.
Yeah, so yeah, super team. So and it's interesting because um Brian came from a single family background too. He has an ongoing property management business here, maybe 500 units. And so it actually took me about 12 to 18 months of talking to him, educating him about multifamily. We looked at 2 or 3 buildings. We finally found one we both like, and now he loves it because he understands. Like on this 43 unit building, they're all identical 1 bedroom units. And so when we renovate them, we don't have to reinvent the wheel every time. We know exactly how much counter we need. We
Right.
know what bathroom mirror to order, and you can really systematize it. And so he's really sold on the multifamily now. But it did take me about a year of let's say courting him. And it was interesting because until I had him in place, I didn't have the confidence to take down these deals myself, because I was aware of a weakness. So uh so evaluate your strengths realistically, be honest with yourself, and then find partners that fill in those gaps. And when you find it, you'll know it. And we have a great time working together. And basically we stay out of each other's way. He has dominion over the operations. You can't micromanage, right? You got to empower people to do their thing. So, which also goes back to these mentoring and coaching programs, because you'll have interaction with these individuals, and you'll maybe you're great with numbers, and you come from a background of money. Maybe you have like a Wall Street background, and you're a finance guy, and you're very analytical, and you want to invest in Kansas City, Kansas. Well, you don't know Kansas City, Kansas, but maybe you can find a guy who knows that market and knows the nuts and bolts, but maybe lacks the financial acumen. And all of a sudden, bingo, the partnership makes sense. So look for those people, and when you find the right ones, that's also how you can kind of ramp up and scale.
Really, really good stuff about partnership and building teams. I'm going to move on. You keep mentioning the 43 units, 2.8 million, and I'm on my 4th page of notes here, by the way.
Oh my gosh.
No, I love this part of the show because as I find out more about it, it just brings up more questions and it just makes it more interesting. So the next series of questions, and maybe it is this 43 unit, maybe it's not this 43 unit, but what was the best deal you've ever done? What type of property was it? How did you find it? And how did you finance it?
Yeah, great question. So we'll stick with the 43 units. It's the one I've owned the longest. And so it was acquired at a very good time. So that's kind of nice. And so it's located in Greenville, South Carolina, where I live. And one of my other advice to newbies is really network in your market, get to know the brokers, get to know the property managers, get to know the insurance agents, get to know some of the contractors, and so forth. So this was a broker that I had met maybe about 18 months prior. And we've been to lunch a couple times. He brought me a couple deals. They weren't right. And then one day he brought me this deal, and he brought it to me first. Went down, took a look at it with my buddy Brian. We liked it. We made an offer, and we were kind of off and running. But this was a relationship with a broker that had been nurtured over a period of 12 to 18 months. And, you know, you want to keep checking in with them. You want to get to know them personally. I mean, do they got kids or not? Are they a golfer? Are they a skier? You know, a little socialization, a little lunch here and there. And then you just want to keep popping up, not as a pest, but every couple of weeks, maybe check in with them. Hey, Jonathan, you found me anything? Anything coming up that I might like? Just to kind of remind them that you're still there. So this was an off-market deal that they brought to me and basically said, Arn, I think this is exactly what you've been looking for. We're going to give you first crack. Uh, I tried to renegotiate the price or negotiate the price. They basically told me to go pound sand. I decided to pay full price, and I'm glad I did. So it was a first look. It wasn't a competitive bidding situation, which often happens. So I got the first look. We went into contract at full price, and that's how I found the deal. And since that time, our relationship has deepened, and the same broker has brought me two or three other deals. So he likes me, I like him. He knows I'll close. I know he'll bring me deals, so it works perfectly. In terms of financing, we got agency debt. And that in and of itself was an experience. So to back up a little bit for the listeners, agency is typically referred to as either Freddie Mac or Fannie Mae debt. It's typically the preferred way to finance multifamily deals. Um, and I would say stabilize multifamily deals because Freddie Mac, Fannie Mae will kind of only lend based on what the property is doing today, not what it could do in a year. And so a lot of people in this space has heard about bridge debt and floating bridge debt and CMBC debt. And those are kind of more leverage situations where they're lending on what the property can be in a year or two. So you can typically get higher loan to value. Freddie Mac, Fannie Mae, a little more conservative. We ended up getting 7 years fixed rate debt at 3.86%. And then the other thing with agency debt is there are usually prepayment penalties. So you want to know what the prepayment penalty is. There's yield maintenance, there's defeasance, and there's step down. And we chose step down because with step down, the prepayment penalty is known and predictable, where with yield maintenance, you just don't know it. So the broker that brought me this deal, their company also has a multifamily debt operation. So I work with them on obtaining what's called a Freddie Mac small balance loan. One note for your listeners, getting a loan on a multifamily is different than getting a loan on your house. And so typically, if you want to borrow 5 million on an apartment building, you have to have a net worth of $5 million. Okay, so you need to have a balance sheet. Your personal income doesn't really enter into qualifying for the loan. They look at what the property produces, the net operating income of the property, use the debt coverage ratio to determine the loan amount. So circling back to my mentor, one of the things about agency debt is they'll only make agency loans to people who have prior agency debt experience. And so you might say, well, how do I get agency debt experience if I can't get an agency debt loan unless I have experience? It's kind of like a chicken and the egg. So my mentor, Reed, has owned lots of buildings, primarily in Austin, Texas, but now he's in Phoenix. He has agency debt experience. So we brought him in as part of the general partner. He served as what's called key principal. He had the agency debt experience. So now I've had that loan for 3 years. So now I have agency debt experience, and I wouldn't need Reed to get another Freddie loan. But you got to start somewhere. And so that's what we did with the debt. And then, Brian, I forgot the other questions about this deal.
Sure, you hit them all. It was a multifamily, 43 units. How did you find it? It was a personal relationship. Took you 12 months to 18 months to build that brokerage relationship. How did you finance it? Some really good meat and potatoes on that. If it's okay with you, like you still own the property.
Yes.
Okay, so it's a little bit different. Sometimes when I talk to someone about their best deal, they talk about the disposition of the property as well. So we haven't done that yet. So I'm going to ask some questions. We'll take this as far down the journey as we are right now. So 2.8 million agency debt. What did you have to put down? 20%?
No, we put down, let me see, we got a loan for about 1.9 million. So we put about 30% down on 2.8, 0.3. So we put about 900,000, $1 million down, and then raised another couple 100,000 for CapEx reserves and closing costs and so forth.
Okay, so I'll say 1 million down, note for 180, which is 30.
$1.9 million, yeah.
1.9 million was the debt?
Yeah, was the debt, yeah.
Okay, 1.9 on debt.
Yeah, so about 900 down, yeah.
Okay, so were there any refi cash out events or anything like that that have happened yet?
No, and it's an interesting interesting topic. So on that property, we've probably increased NOI about 50% over the 3 years. And even at a 6 cap, when we bought it, cap rate in Greenville was maybe about 5. Today it's about 6. I would say the property today is probably worth high 4s, 4.7, 4.8. So we've made about 2 million on the property. Our quandary is we have 3.86% debt for another 4 years.
Mm-hmm.
So we could refi, we could pull out capital, we could return capital to our investors, but we'd have to borrow and pay 6.5%. So in my mind, it doesn't make sense to get rid of that 3.86% debt that we've got another 4 years to go. And most of the, well, all the assets we own, we have fixed rate debt on them, average of about 4%. So we have them from high threes to low fours, and they all have about 4 or 5 years to go. So we're kind of in a holding pattern now because they're operating, they're generating good cash flow. This property's probably now producing 10% cash on cash, which we're distributing to our investors. But we don't want to sell the property. It doesn't make sense to refi at 6.5%. So we're going to hold it. And so I think the hope would be rates drop here in the next 18 to 24 months, maybe allow us to refinance. Or if somebody makes us a blow your doors off offer, maybe we sell it then. So we're just holding. All the properties are operating. We've paid distributions every time we've promised in the amount promised or more. So at this point, it's just steady as she goes.
So this is the fun part of the show for me where I run the numbers. So the equity you've built averages just over $55,000 a month over the 3-year period.
You mean we've built equity of
Yeah, 200 million.
about 2 million? Yes, I would totally agree. We've gone from about 2.8 purchase to about 4.8 now.
So
we built about 2 million equity. The total raise on this deal was 1.5 million. So basically, if we were to sell today, our investors, big picture, who invested 1.5 million would get back 3.5 million.
why would you not do this?
Because then the question is, where are they going to put that money? So yes, and it's an interesting dynamic because as a general partner, most of our compensation is on the back end when the property is sold. Okay, so there's a selfish personal incentive for us to sell, but we're in this for the long haul. And so our guiding principle always has to be what's best for the investors.
Right.
And so in our mind, yes, we could take our profit, take our split, our investors could be happy. But then the question is, where do you put that equity? And could we find anything better? I don't think we can find anything better. So the market's not going to dry up. If rates drop down, because this valuation's at a 6 cap, if rates drop, value continues to go up. So we're just going to ride it out and see. And maybe we refi, pull some capital out, hold the property long term, and use that capital to go buy something else. Greenville is a really strong market, midway between Atlanta and Charlotte. BMW is here. Every X car in the world BMW makes is made in Greenville, Spartanburg. North American headquarters of Michelin is here. GE's here. There's a booming tourism industry. So it's really a solid place, population growth going. So long term, it looks good. And we're just going to ride that wave for the next year or two and see what happens.
Next year or two, we keep hearing that coming up with other investors because, and we can go down that rabbit hole. But I do want to just circle back that 55,500 a month that you've generated in equity on this property resonates very closely to what a college student will be earning per year after assuming probably $200,000 worth of debt for an education.
Or what I was going to say, 55,000 a year is what a parent's going to pay to put their kid in college for a year.
Well, and
You
that's
know, so you better start investing so you can pay for college.
so if you listen, folks, it's a good idea to get started. Now, I guess I am going to take this rabbit hole. You said within a couple of years. We've had this discussion, last couple guests on the show. You've been in the game for a while. You've been in multifamily space for a while. I'm wondering what you see happening in the market, or at least the local market where you are. We have a lot of investors saying yes, but not yet. So what's your take on the market for multifamily right now?
So it's a great question, and I'm maybe a little bit of a contrarian, um, because I don't believe one can actually time the market. So in my experience, the bottom of a market, a top of the market is only known 6 months after the fact. Now,
Right.
maybe you got a crystal ball and you throw a dart. The other thing I've noticed in my years is when the market shifts, it shifts quickly. It can be booming, and then if it starts to turn, it turns quickly. If it's struggling a little bit, once it turns up big time. So for me, I look to buy quality property in quality locations. And if I find something tomorrow that makes sense, that I can make the deal pencil, that I can make the property self-supporting. And what I mean by self-supporting is the rent covers all the expenses, covers all the debt. There's a little margin left over, not a cash flow, not so much that the cash flow is going to make you rich, but the cash flow's that protective layer where if you're at a 5% cash flow, you've got a 5% buffer while the property's still supporting itself. So if I can find a quality property, quality location at a price that I can make work, I'm willing to buy it tomorrow, even if even if I know the value is going to drop in the next 6 to 12 months.
Hmm.
Because for me, I don't care what it's worth a year from now. My finish line is 5 to 7 years in the future, right? So I think we're still in a little bit of turbulence in the multifamily market. I think we may still see some declines in value, but I don't think they're going to be huge. And if you can find, again, quality property, quality location, go ahead and buy it. It would be like, let me make an analogy. If Apple stock today was 80 and the rumblings about earnings was that it was going to drop to 75, but if you believed in Apple was going to be 120 a year from now, you'd buy Apple at 80, and if it dropped a little bit, no big deal because you're on a winner. I mean, Warren Buffett, pretty smart investor, said, I'd rather pay a fair price for a good company than a good price for a fair company.
Wow,
Meaning quality wins out, and quality wins out in real estate. So maybe a little short-term turbulence, long-term I'm bullish. And I guess the other thing I would say, and I've been through a lot of cycles in my day since 1978. I don't have to recite them all, but a lot of ups and downs economically. One, as much as people want to talk about negative issues in America, I still believe we have the strongest economy in the world. And and we're now hearing rumblings that China is struggling, and who knows what you get out of China, whether it's true or not. They always puff up these big economic figures, but I believe in America. I believe in the American economy. I'm bullish long term on the American economy. We have a housing shortage. So, in my mind, long term buying housing is going to be a win. Um, Investors all over the world want to invest in America, right? One, because it's a good place to invest, but another reason is their capital is safe. So people in other areas of the country, particularly China, let's say, uh, they're investing here to preserve their capital. They don't care so much about the returns because they live in an environment where that capital could be taken from them.
Right.
And if you look at the economics of Europe, I would say America's doing better. So I'm bullish on the American economy, and that's why I'm still looking to buy. So that's my crystal ball. I will agree. I don't think rates are going to come down as soon as people think, but I will say, once they start coming down, you better be ready to jump in the market because everybody else is going to be jumping in the market, and and that's why I don't try to time the market. So right now we're buying stuff. We've actually switched to buy new construction because some of the existing deals don't make sense. So we're buying new build to rent product duplexes from builders because builders are motivated sellers. They build to sell, make a profit. That's their business. They're not holding long term. We're paying 7% debt. I paid 11 and 3/4 for my first house in 1980. So 7% debt doesn't make my head explode. We're paying 7% debt. These new build properties will cash flow. We're having to put about 45% down. But if rates even drop to 5%, from 7 to 5, our cash flow is going to go through the roof. And we could probably refi and return capital. And we own brand new product in a growth market. So we like it. And maybe the value drops a little bit, but we're not really concerned. It's the long-term thing. So that's how I kind of do it. I realize maybe a contrarian, but that's how I kind of do it.
No, that is so smart. This, just to put this on the podcast, it's March 14th today. And this week we've been seeing on the news that, there's maybe rumblings that they might stop raising the rates for interest. Maybe that's going to turn around. I had an investor text me and say, hey, they just dropped the rates. Time to invest in syndication. We looked, it's like, well, no, they haven't dropped the rates yet. But if that happens, people like you and people who are buying now are going to look like geniuses because you were buying at a high interest rate. And then when it resets, your margin and gap is just going to split wide open.
Yeah. Yeah. And this debt is the debt we're taking on now is bank debt. It's not agency debt because we're in a lease up situation, but it's 5 years fixed. And so for me, 5 years is plenty of time to let whatever's going on sort itself out, to let the Fed get back, because I think ultimately rates do have to come down. They came down way too much 2-3 years ago, and they stayed down too long. And so now the Fed's having to really take a strong posture, and we're going to hit equilibrium pretty soon. Inflation numbers seem to be stabilizing a little bit. And of course, everybody keeps talking, are we going to hit a recession? But you look at the jobs report, boom, boom, boom. Every month it's positive, so I think we're going to get the soft landing everybody's talked about. And I think 18 months rates will start to come down. But a year ago, we thought they'd come down this year. Now I think we're thinking it's 18 months away.
Really good stuff. Thanks for bringing that to the table. So I'm gonna move on here.
Yeah.
What has been the biggest hurdle you have faced as a real estate investor, and how did you solve it?
Good question. Well, uh, yeah. So the biggest hurdle in the market the last couple of years is finding deals that make any kind of sense. And I like to do deals.
Mhm.
I like to bring everybody together, the investors, the lender. Closing these syndications is like bringing a big ship to dock, right? There's a lot that's got to go on. And I really enjoy that. You've got these 10 balls jumping in the air, and you kind of got to bring them all to this one point at this one time to make it happen. It can be terrifying, but it's also exhilarating. So I like making deals. So the hardest thing for me is, how do I stay patient and not do a deal? And it's interesting to circle back on the partnership aspect. My team is 3 people, primary team: Arn, Brian, and Dan. And I'm kind of the engine. I'm always going, yes, this is good. Let's do it. Let's go for it. And they take the role of the brake, where they go, hold on here, Arn. And you kind of need those voices, And so where we're at in our business is, unless all 3 of us say yes, we don't proceed. And over the years of working with them, I've come to trust their judgment, where I'm kind of very risk tolerant. They're a little bit more risk adverse. And so they're tending to be a little more cautious. So if I find something that they both agree is something we should pursue, that just gives me additional confidence to go for it. So there's an interesting dynamic within the team. Uh, Everybody on the team can't be go for it. You kind of need that voice of reason and say, hold on a second, let's think about it and let's analyze it a little more and think about it. So that's what we've kind of developed within the team. So they help me be patient.
Amen. So
Yes.
we're almost done here. We've only been recording for about 5 hours, so it's been good. No,
Always fun. Time flies.
I want to thank you. You're telling some really great stories, and I hope people get really inspired by what you brought. So I always ask this question, 98% of the time, the answer comes back purple. So was there a book in your investing career that had the biggest impact on you?
Yeah. So it's not Rich Dad, Poor Dad. That's a good staple. So basically, my father was Rich Dad, Poor Dad. Okay. So, he was born in 1921 and actually lived through the Depression. Okay. And so if you actually live, you understand, if you live through the Depression, you understand bad stuff can happen and food doesn't always going to be on the table. So in any case, he was my Rich Dad, Poor Dad instructor. Um, I really like, for people who want to perhaps move into multifamily investing, multifamily syndication. I like the best ever book, the real estate syndication book. I think I've got it here. Hold on.
Yep, Joe Fairless.
Hold
Yes.
on. Let me put it up, get my ears back in. You probably have it too, I bet.
Yeah, I was looking earlier. I know it's back there somewhere. Oh, got it.
Yep, so you show it because somehow it's not showing on my screen.
I just saw it. Here we go. Okay.
Yes, that's the one.
Here it is.
Yes. And I can see you've actually used it, so good for you.
Yes.
But that will take it soup to nuts. and give you a very good background on kind of all of these aspects. And then even with the book, I still suggest little partnership, little mentoring, to kind of hold your hand the first time, first one or two deals through. And then once you get those first one or two under your belt, then if you want to kind of be the lead guy and take the ball and run, I think you can do that. But it helps to have somebody who's been there, done that before.
I got to give props to this book as well, because this is the book that started the Why Not Real Estate podcast.
Yes.
The marketing section in here, my background was marketing. It's like, I can do that. So
yes. And Joe was a marketer too, but before he got in. And so they have a conference. It's in early April. It may be sold out, but I would encourage people to consider going next year if they can't get in this year. A lot of great content. One of my partners, Dan, who's the finance analyst guy, he's an ex-California guy too, but he's living up in Cary, North Carolina. I actually met him at a best ever conference in 2020. And we developed a friendship. Harry's about 5 hours from Greenville. He came down to Greenville. He invested with us in a few deals as an LP. And I knew he wanted to kind of move to active. So now he's part of the active team, acting as a general partner with us. So I can speak from firsthand experience. You can actually find your partner, people who will help you take that next step by going to these conferences. And yes, you may have to talk to 20 people to find the right one and develop the relationship, but a lot of people are at the same spot trying to figure out how to move into multifamily. It's a great space to be in. We know we have a problem with housing affordability in this country, and I don't think anything is fundamentally going to change that. We can't build houses, apartments quick enough to keep up with the demand. The cost of materials and labor is going to continue to go up. So the apartment business, you have an almost unlimited demand for your product, right? And you kind of touched on it before. As an apartment owner, you have a responsibility to provide residents safe, habitable housing. They work hard for their money. They deserve a decent place to live. And in return, they pay rent and the investors profit. In our experience, when you do the right thing by the tenants, your building operation improves, you get better and better tenants. And so it's really a win-win when you do the right thing. So take care of these people. We put in little gazebos with a bench, little dog parks. No big deal. It's not building the Taj Mahal, but just something to make their lives a little better. On this 43-unit building we bought, the units were plumbed for stack washer dryers, but the prior owner didn't supply the stack washer dryers. So when we took over operation, we put in stack washer dryers for all our tenants. And these units were renting for $650 a month. It's now up to about $950. But for a tenant paying $650, to expect them to buy a stack washer dryer for $1,200 is a little bit of a stretch. So we put in the stack washer dryer. Their life is better. They don't have to spend it at the laundromat. They can be at home. It saves some money. We get a little more rent. And, we try to maintain good relations with our residents. And it pays off for the investors too, because good occupancy, rarely any evictions. So it's important. Do the right thing. You'll also be doing the right thing for business.
So what you just mentioned there, the washer and dryers was probably just over $50,000, which was less than 1 month of the profit that you did by even doing this deal. So over 3 years, it's negligible to spend that 50,000.
Yeah, and basically, I think the way I worked it out is if we got an extra $50 a month rent for those units times 43, that's 2,150 a month, times 12, so it's about $25,000 more a year in rent at a 6 cap. That's 430,000 in value. So the 50,000 investment increased the value of our property 430,000. Win-win. And our tenants don't have to sit around the laundromat 2 hours every week feeding the machines with quarters.
Right.
So an improvement like that was kind of a no-brainer. And so as an operator, the other thing we've implemented is bulk cable. So we'll sign a bulk cable contract on this 43 unit one. I think we're paying Spectrum. They're the provider here. I don't know what you have in your area, but Spectrum, I think we're paying them like $30 a month per unit, but we charge the tenant $60 a month. So we get a profit of 30. And again, the benefit is if the tenant went direct to Spectrum, Spectrum's charging them $100. So we're making a little money, the tenant's saving a little money. And so again, it's just a win-win. And so with multifamily and having all these units, you can just kind of incrementally increase these profit sources, and it can have a big impact on the bottom line, where it's harder if you had 43 houses. There's no way you'd implement most of this stuff.
Economy of scale. So we're almost wrapping
Yes.
up here, and I don't want to make you late for your next one. Was there a second book that had an impact on you?
Well, the other one I would say, I got it here. Um, so there's another young guy in the business. Well, Joe's middle age. Well, I'm old, so everybody's young. So the other one I like is a book by a guy named Rob Beardsley. He's a syndicator out of New York that specializes in Texas investments, primarily Houston, but really sharp guy. And he has a little book. It's available on Amazon, Structuring and Raising Debt and Equity for Real Estate. Beardsley, Beardsley, Rob Beardsley, Structuring and Raising Debt and Equity for Multifamily. So included in that purchase, and I think it's like $9, so it's no big deal. I think he also provides his underwriting software, his model for free. So if people want to start underwriting these deals, that's a good source. So that's a great book too. So yeah, that will keep everybody busy.
Arn, you brought so much value to today's show. I want to thank you so much. So there's a little surprise question that's not in your notes, but what question should I have asked you on today's show that I didn't ask?
Oh, I don't know. I think you did a great job as an interviewer. Don't think I have too much to add. Real estate's a great profession. It's fun. You can do it forever. And you're also part of the community and you're improving the community. So I get good feelings about that too. So that's the other part. There's some aspect of connection to your community and helping making your community a little bit better when you go in and you upgrade these buildings and provide a better experience.
So what's next for you in real estate, and why not get started?
Yeah, I'm started. I'm looking for my next deal. We got two 506B deals in the pipeline, so I can't really say much particular, but we are really bullish on the new construction now, and that's what we're focusing on. That's not to say we don't want to buy existing product, because we do. But right now, there's still a little bit of price disconnect between the seller and buyer expectations, and it's hard to put together existing deals. We own stuff built in the 70s, 80s, 90s, 2000, and new. So we're kind of agnostic as to age. And most people generally start with the older property. But I guess one advice would be is if you could start by buying something built late 80s, early 90s, that might be a good place for the newbies to start. There's some value add there, but it's probably more just cosmetic as opposed to having mechanical systems near the end of their life. When you buy a 70s building, there's often unforeseen problems. And so if you could start a little newer, keep the renovations to like kind of a cosmetic thing, you might find it go a little better for you. So I'd look for a little bit newer product if you can find it.
Arn, I want to thank you so much for your insights on today's show. If our viewers want to get in touch with you or find out more about Spark, how should they look you up? Where can they find you?
Well, thank you. Yes. So the website is investwithspark.com, all one word, investwithspark.com. And I'm very active on social media, either under my name, Arn Cenedella, or Spark Investment Group. And as you can tell, Brian and I love talking real estate. So anytime anybody wants to reach out, I'm here in Greenville, South Carolina, which is up in the northwest part of the state. And happy to chat real estate and hopefully help you get where you want to go.
Ladies and gentlemen, my guest today, Arn Cenedella, Spark Investment Group. I want to thank you once again, Arn, for being on the show today.
Appreciate it. Great meeting you, Brian.
And ladies and gentlemen, all my real estate peeps, this is Brian Lucier from the Why Not Real Estate Podcast signing off, and we'll see you on the next one.